Hi everyone, today we'll be going over accounts February-March 2020, paper 3-2, question number 1. This is structured paper 3 which consists of 6 questions, each of 25 marks, and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And this question number 1 is a part of section A which deals with financial accounting. Now without any further delay, let's get started. Tea Limited, a manufacturing company, extracted the following balances from its books of accounts for the year ended 31st December 2019. Alright. Tea Limited transfers the finished good to the trading section of the income statement at total cost plus a markup which is not constant, which means that our markup differs each year. The transfer price represents the amount that the Tea Limited would have had to pay if the goods were purchased from an outside supplier. Then the transfer value for the year ended 31st December 2019 was 632,400 and the markup for the 2018 transfer value was 20%. Okay, since this is the markup for the year 2018, it means that this will be the markup applied to the finished goods at the date of 31st December 2018. Right, and since we are talking about the year end of 31st December 2019, this will act as our opening balance, right? So let's figure out the unrealized profit for our opening inventory of the finished goods. Let's have a look above. We can see that our inventory is given right here, and for finished goods, it is given at cost, which means that this does not contain the markup. Now we can easily figure out the unrealized profit. Okay, so for opening inventory, we know that the markup was given to be 20% for 2018, and this markup is just going to be our profit, right? Which means that 20% of the cost is going to be the unrealized profit. In this case, we have the cost to be 55,000. And we now just multiply it with our markup percentage of 20%, which we can write down as 0.20. And this gives the unrealized profit on our opening inventory to have the value of 11,000. Now we can figure out the transfer value of opening inventory. Alright, the transfer value is just going to be cost and profit. And we are given the cost to be 55,000 and the profit is 11,000. Now this gives our transfer value of the opening inventory of finished goods to have the value of 66,000. Okay, let's have a look at our third information. We are given the inventory at 31st December 2019, which means that these are the closing inventory. And at 31st December 2019, rent and rates remaining unpaid amounted to 3,000. So if this is unpaid at our year end, this means that this is the year end accrual, which should be included in the current year's expenses, right? So I'm just going to add the 3,000 to our rent and rates. Okay, rent and rates is right here. So I'm just going to add 3,000 plus 72,000, which results in our total rent and rates to be 75,000. Alright. Then we are also told that the depreciation charge for the year 2019 amounted to 48,000. Now the following expenses are to be apportioned as follows. For rent and rates, 3 out of 5 parts belong to factory and 2 out of 5 parts belong to administrative department. And we just figured out the total for rent and rates to be 75,000, right? Let's apportion it. So 3 out of 5 is for factory. That is just going to be 75,000 times 3 by 5, which results in the value of 45,000. So rent for factory is going to be 45,000. And for administrative, that's 2 by 5. So 75,000 times 2 by 5, which results in the value of 30,000. Alright, next one is repairs. Let's have a look above. Okay, repairs is given right here. And the total is 18,000. Now we just need to divide it among our factory and administrative department. The total is 18,000. Now for factory, that's 3 out of 4 parts. So 18,000 times 3 by 4, which results in the value of 13,500. So repairs for factory amounts to 13,500. And for administrative, that's 1 out of 4 parts. So 18,000 times 1 by 4, which results in the value of 4,500. That's for administrative. And finally, we have depreciation, and we are given the total depreciation charge to be 48,000. So the total is 48,000, and 2 out of 3 parts belongs to factory. So that's 48,000 times 2 by 3, which results in value of 32,000. So 32,000 is the depreciation to be charged to our factory. And for administrative, that's 1 out of 3. So 48,000 times 1 by 3, which results in the value of 16,000. This is the depreciation charge in our administrative department. Alright. Now for the first part of this question, we need to prepare the manufacturing account for the year ended 31st December 2019. Let's do it. We are preparing it for Tea Limited. And this is our manufacturing account. For the year ended 31st December 2019. Now the very first section of our manufacturing account would be the prime cost. So we need to add all of the direct costs, right? And we can start with our cost of raw materials. And the cost of raw materials would be similar to that of our cost of sales that we prepare in the income statement. We're going to start with the opening inventory, then add all of our purchases, subtract all of the carriage inwards, and subtract our closing inventory. I'm just going to write down the format. So that's opening inventory. And these are all relating to raw materials. Then we add all of the purchases made in this year. Then we subtract all of the carriage inwards cost. And then we also subtract the closing inventory. And then this will give our total cost of raw materials. So that's cost of raw materials consumed. Let's have a look above. Okay, the opening inventory is given right here. And for raw materials, it is 17,300. So I'm just going to substitute this value. That's 17,300 for opening inventory. Now we need to add all of our purchases of raw materials, which is given right here. And it amounts to 200,400. Let's write it down. That's 200,400. Then we have our carriage inwards. And we can see it right here. It amounts to 6,600. Let's write it down. That's 6,600. Okay, I subtracted the carriage inwards. That's incorrect. Carriage inwards should always be added because these are the expenses and we are trying to figure out the cost, right? So this should definitely be added. Now we need to subtract our closing inventory of raw materials. And it's given right here, which amounts to 18,700. Let's write it down. That's 18,700. And we need to subtract our closing inventory, so I'm just going to write down in a bracket. Now we can figure out the cost of raw materials consumed by adding these four amounts. That's 17,300 plus 200,400 plus 6,600 minus 18,700, which results in our cost of raw materials consumed to be 205,600. Now we need to add all of our direct costs. Let's have a look above. Okay, so the very first direct cost is our direct wages, which amounts to 206,400. Let's write it down. That's direct wages of 206,400. Okay. Then the next direct expenses would be the direct manufacturing expenses, right? And that's 8,600. Let's write it down. Direct manufacturing expenses. And that was 8,600. Okay. The next one we have is rent and rates, which we already apportioned for our factory as well as administrative department. But remember that rent and rates is not a direct expense. This is an indirect expense which should not be included in our prime cost section, right? So I'm just going to skip it for now. Then we have carriage outwards, which is actually included in our income statement rather than the manufacturing account. So I'm going to skip this as well. Then we have other administrative expenses, which should also be included in our income statement. So this means that we have included all of our direct costs. So now we can figure out our total for the direct costs, which we term as prime cost. Okay. So the prime cost will just be the sum of cost of raw materials consumed, direct wages, and direct manufacturing expenses, which is 205,600 plus 206,400 plus 8,600, which results in 420,600. Now the next step would be to add all of our indirect expenses. And the very first one was rent and rate. So I'm just going to write it down. And we already apportioned it towards factory as well. And for factory, the rent and rates amounted to 45,000. Let's write it down. Okay. Then the next indirect expense is repairs. And for factory, that amounted to 13,500. Let's write it down. That's repairs of 13,500. Okay. And the next indirect expense was depreciation, and for factory that's 32,000. So let's write it down. And this was of 32,000. This also concludes all of our indirect expenses. So now we can figure out the total of direct as well as indirect expense. In this case, that will be the sum of these four amounts. So that's 420,600 plus 45,000 plus 13,500 plus 32,000, which results in the value of 511,100. Okay, so this concludes all of our direct as well as indirect costs. Then the next step would be to subtract the closing work in progress from the opening work in progress, and we include all of our work in progress in the manufacturing account, because remember that work in progress is neither a complete raw material nor a finished good, so it will still be in our factory, right? So we need to do that. Let's write it down. Let's have a look above for the values of opening and the closing balance of work in progress. Okay, we can see that the opening inventory was given right here, and for work in progress that's 20,400. That's the opening value, and for closing inventory it's given right here. For work in progress that's 21,500. Let's write these two amounts down. For the opening inventory, there was 20,400, and for closing inventory, there was 21,500. And remember that we need to subtract our closing inventory, so I'm just going to write it down in a bracket. Now this will give our cost of production. Okay, that's the sum of these three amounts. That's 511,100 plus 20,400 minus 21,500, which results in our cost of production to have the value of 510,000. And remember that for our manufacturing account, we have to find out our transfer value rather than the cost. So in order to figure out the transfer value from cost, we just need to add the manufacturing profit, right? And this will give the transfer value. So we were told that our markup differs every year and it's not constant, but we were also given the transfer value for this particular year right here. The transfer value for the year ended 31st December 2019 was 632,400. So let's copy this as our transfer value for the manufacturing account. That's going to be 632,400. Now our manufacturing profit acts as the balancing figure, and whenever we're trying to figure out the balancing figure, we just need to subtract this amount from our total, and in this case that's 632,400 minus 510,000, which results in our manufacturing profit to have the value of 122,400. Okay, This concludes our manufacturing account as well as the first part of this question. We can now move towards the second one. We are given the working section, so rather than scribbling all over the question paper like I did, you guys should be showing all of your workings in this particular box. Now for the second part of this question, we need to prepare the income statement for the year ended 31st December 2019. Okay, we will be preparing it for T Limited. And that's the income statement for the year ended 31st December 2019. Okay. And whenever we're talking about income statement, we always start with our revenue, right? Let's have a look above. Okay, we were given the sales revenue right here, which amounted to 782,000, and we're just going to copy this amount into our income statement. So that's 782,000. And the next step would be to subtract all of the cost of sales, right? So less cost of sales. And if it were an income statement for a company rather than a manufacturing company, then our cost of sales would have included opening inventory, purchases, and closing inventory. But since we are talking about an income statement for a manufacturing company, we need to include our opening inventory, and instead of purchases, we will have our transfer value and then subtract the closing inventory, right? But the thing to remember here is that the opening inventory and closing inventory should also be included at its transfer value rather than the cost. Okay, so the first one is opening inventory, and this should be at the transfer price. Then we need to add our transfer value, and this transfer value is the transfer value that we figured out in the manufacturing account above. Then we need to subtract the closing inventory, and the closing inventory should also be at a transfer value rather than cost. Now let's have a look above for our opening inventory. And we actually already figured out its unrealized profit as well as the transfer value right here. So the transfer value of opening inventory is 66,000. We're just going to copy this amount. Let's do that. Okay, so that's 66,000. The next step would be to add our transfer value. And we can see the transfer value is 632,400. Let's write it down. And lastly, we need to subtract the closing inventory, which should be at its transfer value. Okay, we were given the closing inventory right here, and we can see that this is at a transfer price rather than the cost. So we're just going to copy this amount of 75,888. Okay, and we need to subtract this, so I'm just going to put it in a bracket. Now we can easily figure out the total for our cost of sales by adding these three amounts. That's going to be 66,000 plus 632,400 minus 75,888, which results in the total cost of sales to have the value of 622,512. And since we need to subtract the cost of sales as well, I'm just going to put this in a bracket. Okay, since we already have our revenue as well as the cost of sales, it is very easy to now figure out the gross profit. Gross profit is just the difference between revenue and cost of sales. And in this case, that will be 782,000 minus 622,512, which results in a value of 159,488. Okay. Then the next step would be to add our manufacturing profit. And we always add manufacturing profit to the gross profit if we are talking about an income statement prepared for a manufacturing company. And this is the case because remember that all these cost of sales includes the transfer value, which means that it definitely includes the profits as well, right? And we are subtracting the cost of sales. So in this process, we will also be subtracting our profits, which should not be the case. We need to add our profits, right? So since it was subtracted before, in order to cancel out this effect, we will be adding it again. Okay, let's have a look at our manufacturing account. And we can see that the manufacturing profit amounted to 122,400. Let's substitute this value. Now we need to add any other incomes. And in the above information, we could see that all that was mentioned was expenses. So the only other potential profit or income could be if there was a decrease in the unrealized profit amount, right? And we already figured out the unrealized profit amount for the opening inventory right here, which is 11,000. Now we need to figure out the unrealized profit for our closing inventory of finished goods. And in order to do so, we first require our markup percentage, right? So markup is basically just the profit divided by the cost times 100%. And in the year of 2019, we can see that our total cost is 510,000, right? So that's 510,000. And the total profit will be the manufacturing profit, which is of 122,400. Now we just need to multiply it by 100%. And this results in our markup for this year to be 122,400 divided by 510,000 times 100%, which results in 24%. So while figuring out the transfer value, we add 24% of cost. That is the markup, right? Now we will be figuring out our unrealized profit for the closing inventory. Okay, and in this case, we can see that the finished good is given at the transfer price, right? Which means that this includes the cost as well as the profit. So cost plus the unrealized profit is going to be 75,888. And we know that the unrealized profit will be 24% of the cost because that is our markup percentage. So cost plus 0.24 times cost is going to be 75,888. Now if we take the C common, that will be 1.24 times the cost, which is 75,888. Now we can easily figure out the cost, right? That's 75,888 divided by 1.24, which results in our cost to be 61,200. And now in order to figure out the unrealized profit, we just need to subtract the cost from our total transfer value. So our unrealized profit is going to be 75,888 minus the cost of 61,200. And this results in the value of 14,688. Okay, this is the unrealized profit related to the closing inventory. And we already figured out the unrealized profit for the opening inventory to be 11,000. And we can see that the unrealized profit has definitely increased, right? Let's figure out the increase in unrealized profit. That will be the unrealized profit for the closing inventory minus unrealized profit for opening inventory, which in this case is 14,688 minus 11,000, which results in our increase in unrealized profit to have the value of 3,688. And remember that before I said that if there was a decrease in unrealized profit, that would have acted as our income. But since we can see that there is an increase, this will act as our expense, which means that this should be included in the overhead section. And there is no other income to be added. So let's start our overhead section by the increase in unrealized profit. Okay, then we can subtract all of our overheads, starting with the increase in unrealized profit, which you just figured out to have the amount of 3,688. Okay, then the next overhead would be that of rent and rates, and for administrative section we figured it out to be 30,000. And this administrative section just means that these expenses should be recorded in our income statement. So let's record the rent and rates of 30,000. That's rent and rates of 30,000. Okay. Then we also have our repairs, right? And for administrative section, it was 4,500. Let's record this. That's repairs of 4,500. And now we have our last one that we apportioned, and that is of depreciation. For administrative section, it was 16,000. Let's write it down. That's depreciation of 16,000. Okay. I think we were given carriage outwards as well. Yes, right here we can see that the carriage outwards amounted to 16,300, and this should be included as an overhead in the income statement. Let's write it down. So that's carriage outwards of 16,300, and we are also given other administrative expenses. Right here, the other administrative expenses amounted to 66,200. Let's write it down. And this concludes all of our overheads. So let's figure out its total. That will be the sum of these six amounts: 3,688 plus 30,000 plus 4,500 plus 16,000 plus 16,300 plus 66,200, which results in our total overheads to have the amount of 136,688. And since this is an overhead that we need to subtract, I'm just going to record this in a bracket. Now we can easily figure out the profit for the year. And profit for the year is going to be gross profit plus manufacturing account minus the overheads. And in this case, that's 159,488 plus 122,400 minus 136,688, which results in our profit for the year to have the value of 145,200. Alright, this concludes our income statement as well as the second part of this question. Now we can move towards the third one. And we were given the working section, so instead of scribbling all over the question paper like I did, you guys should be showing all of your workings in this particular box. For the third part, we need to calculate the amount at which the finished goods are included in inventory at 31st December 2019. And this is just the cost, right? Because whenever we are valuing inventory, we always value it at the cost. And we already figured it out above. So the cost of inventory, since we already figured it out and showed all of our workings above, I'm just going to write down the final cost, but make sure that you guys show all of that working in this particular solution section. Let's have a look above. We're talking about the closing inventory for this year, right? And we figured out our markup percentage to be 24%, and by using the relation, we figured out our cost to be 61,200, and this is the value at which our inventory would be recorded. So I'm just going to write down this amount of 61,200. But since the question asked us to calculate it, that would be our cost plus profit to have the amount of 75,888. And remember that we figured out our markup to be 24%. So the profit is just going to be 24% of cost. So that's C plus 0.24 times cost to be 75,888. And that is just 1.24 times cost to be 75,888. And in this way, we figured out that our cost will be 75,888 divided by 1.24, which gives us the final value of 61,200. Alright, this concludes the third part of this question. We can now move towards the fourth one. We need to explain, with the support of accounting concepts, the treatment of unrealized profit on finished goods in both the income statement and the statement of financial position. Okay, so the very first thing to understand that is that we are terming our profit as unrealized. And this is the case because the goods have not yet been sold to the customers. Otherwise, it would not have been included in our inventory, right? Let's write it down. Profit is unrealized because goods have not been sold to customers. Now, if we are talking about the treatment in the case of income statement, like I said before, increment in unrealized profit is always deducted from the profit in the income statement because we treat it as an expense or overhead. Let's write it down. Increase in unrealized profit is deducted from the profit in the income statement and this is followed under our realization concept, which states that profit should be only recorded once it has been realized, but we are talking about unrealized profit. So let's write it down under the realization concept. Now let's talk about its treatment in the statement of financial position. So unrealized profit should be deducted from the transfer value in order to figure out the cost of inventory, and we would only be including those costs of finished goods inventories in our statement of financial position. Let's write it down. Unrealized profit is deducted from the transfer value of finished goods inventory to show the cost of finished goods inventories in the statement of financial position. And this is done under the prudence concept because it states that assets should not be overstated, and in this case our inventories are the assets, right? So this is done under prudence concept, which states that assets should not be overstated. And this concludes the fourth part of this question. We can now move towards the fifth one. We now need to advise the directors of Tea Limited whether or not they should continue basing the transfer price on the price paid to an outside supplier. We need to justify our answer. So if we are comparing it with the price to be paid to an outside supplier, it means that we are comparing it with our competitors, right? If that is the case, then it can help to make more meaningful price comparisons. Let's write it down. And since we are basing the transfer price on the price paid to an outside supplier, it means that it could fluctuate throughout the year, right? That could be a disadvantage. Let's write it down. The price of the outside supplier may fluctuate throughout the year. Now, based on these factors, we need to advise the directors. Personally, I would prefer that the directors continue basing the transfer price on the price paid to an outside supplier because it would mean that our price is consistent with that of our market competitors. Let's write it down. So, decision is that the directors of Tea Limited should continue basing the transfer price on the price paid to an outside supplier. And this concludes the fifth part of this question as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.